Good afternoon or good morning or good evening wherever you are in the world, and welcome to this, the Association of Corporate Treasurers' second video webinar. Today we'll be talking about investing in repurchase agreements, or repos as they are more commonly known. I'm Michelle Price. I work in the policy and technical team here at the ACT, and I'll be chairing the discussion. I thank Euroclear for sponsoring this event today, which will last for about 45 minutes. Here at the ACT, we've seen a growing trend of corporates using repos as an investment product. We reissued our briefing note on repos back in 2014, and it has proven very popular. In today's webinar, we intend to cover the question, why use repos, and also to look at the practical aspects of how to invest in repos. I'm delighted to welcome from Euroclear, Olivia Deschatzen, Head of Product Solutions, and our corporate panellists from 3i, Matt Shelley, Group Treasurer. Olivia and Matt each have a brief presentation which will be followed by a Q&A panel session. I'll be asking a few pre-prepared questions, but you also have the chance to ask questions as well. You'll see a submit a question button on your screen that allows you to send them in. Please don't wait until the end. Send them in as soon as you think of them. We won't mention your name or company, so feel free to ask anything. Olivia, we'll kick off with you.
Thank you very much, Michelle. Thank you for organizing and setting up this webinar, and I'm glad to be here with Matt to talk about Repo. So first of all, who is us, so Euroclear? So Euroclear is an ICSD, so International Securities Depository, covering more than 40 markets in the world and offering custody and settlement services for over 800 customers globally. Within the product range, we also offer collateral management services, and we have more than 1 trillion euro worth of securities that we manage on a daily basis in order to offer services for more than 250 customers. So I thought I would go through a couple of slides just to initiate the repo discussions by just giving you some thought about what are the main drivers of corporate treasurer for opting repo. So there are actually two main drivers. So the first one is to preserve capital of their cash investment, so to decrease the direct banking exposure, but also to meet their yield target. So we're going to see through this little presentation how can we strike the right balance between preserving the capital while maintaining the yield targets. Preserving capital is really moving from return on capital to return of capital. So how is Repo coping with this? Basically by just introducing the concept of double indemnity. So the exposure the corporate treasurer will take on the bank is mitigated by the collateral. So the direct exposure will remain on the bank, which is the prime first line of defense, but it will be mitigated by collateral, which means that in the event of default of the repo counterparty, the cash investors recover its investment by selling the collateral to the market. This is the second line of defense and the double indemnity. So visually, this will be like showing on the slide. So the corporate treasurer will exchange the cash for securities throughout the life of the repo transaction. Meeting yield target is also important, specifically in this low rate environment that we're living in. And the repo market is actually offering a wide range of collateral baskets, which is a new variable that can be adjusted in order to meet the yield target of individual cash investors. So you will see on the line different yield curve. This is indicative repo rates for June of this year in euro. And you will see on the slide, on the low part of the slide, the bottom part is the green line, which is actually the lowest rate available on the chart, which is actually the deposit rate of the ECB minus 20 basis points. So you will see that the repo rate of the different baskets shown on the screen, whether this is a government basket, a government bond basket, or investment grade basket, including corporates, or equities, or even in emerging market, will actually give the possibility to achieve a different yield depending on their maturity. So from the highest quality, which is the government bond sector, you will see it's very on the low hand side, but if you open up the basket to corporate debt or equities or emerging market, you will see that the rate is higher for your investment. So again, a wide range of variety of basket that the corporate treasurer can choose to meet its yield target. And the concept of collateral is a new dimension introduced by Repo on top of the selection of the counterparty and the duration of the transaction. So the double indemnity means that the corporate treasurer will have to receive securities collateral as a mitigating of the credit risk vis-à-vis the bank. The collateral will mean that it has to be managed, implies collateral management, which is not necessarily what the corporate treasurer are familiar with. And this is why the outsourcing solution, the tri-party collateral management solution, is actually a good opportunity for the corporate treasurer to offload the burden and the operational burden and the risk management of the collateral to an agent with no direct investment and no servicing fee, as the servicing fee are typically taken by the bank counterparty. Just to look at what are the main barriers of entry to entry for the corporate. So I've listed a couple of challenges on the left-hand side of the slide, but you will happily see that on the right-hand side there's a solution for each of them. So let's go through them one by one. The first one is heavy legal documentation. So there is a lengthy negotiation of bilateral contract. That's what we're hearing from our corporate treasurer clients. So the bilateral contract in repo is the GMRA, stands for Global Master Repo Agreement, and is the highest hurdle to entry to repo markets. So there's a solution to overcome that hurdle, and this is the solution that we call here in Euroclear Repo Access, and the solution will be to join Repo Access community, and I'll come to that in a minute. Complexity of managing collateral is another challenge for the corporate treasurer. As I mentioned, they're not used to manage securities, and the collateral is potentially an additional burden. The solution will be to opt for proven tri-party solutions that are available on the markets. The low rate environment is an issue for corporate treasurer, and specifically for euro currency, as the euro deposit is in negative territory, which is an issue for a corporate treasurer. And as I mentioned earlier, by adjusting the basket to include a wider range of collateral will allow the corporate treasurer to go to positive territory and meet the yield target. Limited price discovery is also coming as a feedback, as a hurdle to the repo market, which is where is the market traded, and we start to see initiatives that are targeting corporate treasurer in a trading venue. So we see some initiative coming from Société Générale in the ACM, so agency cash management. Another solution will come end of this year called DBVX. So we start to see trading venue coming up with solution for corporate treasurer. Let me go back to one aspect of the hurdle, which is the legal documentation. So as I mentioned, in order to step into the repo market, the bank and the corporate will have to enter into a GMRA, a Global Master Agreement, which is what we call the bilateral agreement. If they both opt for tri-party collateral management services, they will need, on top of that, to complement the contract by having a repurchase service agreement with the tri-party agent. In order to facilitate the entry of the corporate treasurer, we have designed in Euroclear a standard GMRA that we propose to the corporate treasurer. In that framework, we would actually act as signing agent on behalf of the corporate treasurer, which will facilitate the entry to the market. So the corporate will indicate the banks they want to deal with, and we will propose to this bank to sign the standard GMRA on their behalf. This is a way to decrease the number or decrease the burden of legal negotiation and increase the speed of being ready in repo. Just to conclude on that one, repo for corporate treasurer is really getting the best of both worlds. By joining the community of repo participants, the corporate treasurer will benefit from this double indemnity on the cash investment, will be able to meet the maturity target, design this bespoke collateral basket to meet the yield target, while not having to invest into a new infrastructure by opting for tri-party services and giving the management of the collateral to a third party specialized, and to delegate all the burden of operation related to collateral, and avoid investment risk at no cost, as I mentioned earlier. The servicing fee for collateral management in Triparty is paid by the bank. On that note, I will pass the word to Matt, who will give a couple of thoughts on that.
Thanks, Olivier.
Thank you. So in my slides, I'm going to give you a little bit of background on 3i, and then moving on to a bit of background around 3i Treasury. I'll talk you through why we decided to use Repo and actually how we use Repo. I'll run you through the key learnings and watch-outs from our setup process, and then I'll do a little wrap-up after that. So about 3i, we have 3 business lines. We invest the bulk of our proprietary capital in private equity, so mid-market companies, focusing mainly on Northern Europe and North America. We have an infrastructure business, so 3i Group PLC owns 34% of 3i Infrastructure PLC, which is a separately listed FTSE 250 vehicle that invests primarily in core economic infrastructure within Europe. And then finally, we have our debt management business line, which is investing in senior secured loans, primarily through CLOs. So the Treasury team at 3i, we look after all Treasury matters for 3i Group PLC and for 3i Infrastructure PLC. So cash and liquidity wise, we look after cash management for those businesses and investing the cash. We've got north of 800 million in cash for 3i Group and a much lower number for 3i Infrastructure PLC. For FX risk management, we are for 3i Infrastructure PLC, we've got a rolling net investment hedging program. For 3i Group PLC, we're primarily doing transaction hedging on PE investments, so the investments and the divestment cash flows. 3i Group has got 3 bonds maturing out to 2032. We're not in issuing mode, so it's primarily debt investor relations there. We've also got a 350 million RCF that we refinanced last year. Myself and Ian Cooper also support our PE investee companies with interest rate hedging. And then finally, I sit on the pension investment committee as well. We've got 4 people within the team, 2 in the front office, 2 in the back office, and that's a much smaller sized team than we had, say, 2 or 3 years ago. So, talking through why 3i decided to use Repo. Short-term deposits have become quite unattractive for banks, particularly for non-bank financial institutions such as 3i. And then looking at the proposed money market fund regulations, they didn't look very positive when they were first announced, and that's when we started to prepare for Repo. I formed a view over time that too much diversity can be a bad thing. So when you're investing in in a number of different money market funds, actually understanding what your aggregate exposure is can be quite difficult. Now the X-ray reporting for that has improved over time. But it still takes a little bit of monitoring. We didn't want large single name bank exposures from a credit perspective, but we also didn't want too many small investments from a resource constraints point of view. As I say, the team used to be an awful lot larger, and there's only 4 of us today. Doing a segregated mandate, I thought actually created quite a few of the issues that were coming out of the money market fund regulations, so mark-to-market, accounting, etc. And then finally, we'd already actually negotiated a GIMRA as part of setting up a CLO, where we'd repurchase some assets for that. And then finally, I just think we came to the view that actually Repo was complementary to money market funds. So how do we use Repo? So we have tri-party accounts at Euroclear for both 3i Group PLC and 3i Infrastructure PLC. And we also then have an account for 3i Group PLC at Clearstream. So our collateral sets are gilts today, but we are just in the process of setting up collateral sets for treasuries, bonds, and Dutch sovereigns. When we're taking sovereign debt, we don't offer or accept any restrictions or haircuts. We have 9 GIMRAs that are executed. We have 5 that are live today. I'd expect more of those to become live as and when we extend those collateral sets. For execution, we execute everything on Bloomberg. We use telephone just to keep up to date on the market and make sure we're aware of what's going on, but all execution is on Bloomberg chat. And then the bank sends an RPOV message through Bloomberg that actually acts that facilitates us confirming the trade. So we book the repo in our treasury management system. The back office team check the ARPOV to make sure that it's correct. And then the front office team within Bloomberg actually allocate and affirm the transaction to Euroclear and Clearstream through that communication channel. For collateral monitoring, one of the things we wanted to do was to not introduce any new systems, which is partially why we ended up choosing Bloomberg for execution. We already had 2 terminals. So actually for monitoring our collateral positions, we get emailed reports from both Clearstream and Euroclear. They get monitored by our back office and the depository that we have under AIFMD. Our approach to credit risk is always to focus on the primary counterparty and not look so much at the collateral. Obviously, we're taking risk-free credit risk on the collateral, given that it's sovereign debt and highly rated. We do have processes established to sell the collateral in the event of a counterparty default. I think it's important to set that up at the time. And then for tenor, we are investing up to 2 months. I want to keep our cash relatively short term, given geopolitical risks, the shape of the yield curve, but actually there is a sweet spot for high credit quality collateral in the shorter dates rather than the longer dates, particularly in comparison with, say, money market funds or unsecured deposits. So the key learnings and watch-outs for us actually setting this up, GMRAs aren't that difficult to negotiate once you've really understood them and invested the time in understanding how they operate. We used a law firm for advice, but actually they do a good guide to them as well. And that covers off the 2000 and the 2011 GMRA standards too. And it's worth remembering that a good number of terms within the GMRA are overridden by the tri-party agreement. Some banks only use Euroclear or Clearstream. That was what drove us to actually using both of them. We didn't want to be separated from, say, half or a third of the banking market. The setup process with Euroclear and Clearstream can take time, probably about 6 to 8 weeks for both. It takes a little while to do, and it's quite mechanical. It's not difficult, but it's involved. Both agencies will guide you through the process, and actually both agencies are actually able to recommend to you which particular counterparties would be interested in taking the collateral sets that you're interested in. Banks aren't generally used to using Bloomberg for tri-party trade confirmations. They are used to using it for bilateral, but not necessarily tri-party. With every new bank that we took on, the first transaction didn't work well, but actually once you've got it set up, it works pretty well. And then finally, gilts tend to be held in Crest for bilateral repo, and not all counterparties are willing to move them into Euroclear or Clearstream. Hence the reason that we only have, say, 5 live counterparties when we have 9 GMRAs in place. So on collateral, I find the psychology of repo really interesting. So whenever I have conversations internally about it, people will always focus on the collateral quality rather than the primary counterparty, which is always my approach for this. I talked about making sure that you have robust processes to actually sell the collateral in the event of a default. I've already talked again, shorter dated repo for risk-free collateral. That seems to be a real sweet spot on the curve at the moment. And then finally, notice repo fitting in with the liquidity capital ratio. It seems to be quite attractive for banks where you've got higher risk collateral. So to wrap up, it's a useful diversification away from money market funds for us. It is an investment in time to set it up, but actually I feel it's been worth it. We can take on new counterparties relatively quickly now that we've got the experience around the GMRA, and now repo has become normal course of business for 3i.
Excellent. Thank you very much, Olivia and Matt. We've got questions coming through, but let me kick off with a few pre-prepared questions which I've got at the moment. Let's start with deal size. Olivier, what is the average or typical size that you find corporate treasurers deal in repos?
Well, it will obviously depend on the size of the cash that is available to the repo market, but we see the initial stage for making sense to go into the repo market with ticket of between 30 and 50 million euro equivalent.
Okay.
That's what we see.
Has that increased or decreased in the last couple of years?
Well, we haven't seen dramatic changes into that. It seems to be the entry point for the repo market, and obviously for the banking counterparty to take as a repo counterparty. So I would say the entry level will be between 30 and 40,
okay.
30 and 50 euro equivalent.
And Matt, what's your typical deal size for when you're investing in repos with 3i?
So it's typically a ticket size of 50 million sterling. It's been as low as 25, it's been as high as 80 odd. But as I say, we want to make sure that we're maintaining the repo relationships, so we tend to share them out.
Okay. A question which has actually come in on this topic is, and Olivia, this is probably to you, what is the smallest trade you have placed in terms of value as well as time frame, or as time period?
Well,
what's the smallest trade?
I would say indeed in some cases we have trade below the 50 million mark. But I would say it's unusual. So I would say it's something like 30 million would be the smallest one, and obviously the shortest tenor will be overnight, which is definitely not the bulk of the business that we currently see. Because as Matt said, there are some benefits from moving to the regulatory maturity for the banks, so they tend to go a little bit longer than in the very short end of the curve.
Okay. Moving on to collateral. Olivia, again, first one for you. What are the typical types of collateral that you see corporate treasurers putting into their collateral baskets?
Well, we actually see a wide range of collateral used by corporate treasurer, and to refer to what Matt was saying about the setting in the repo program, some corporates are coming up into the corporate in the corporate repo by getting the most the safest collateral possible, which is like AAA government bond, for instance, as a collateral basket, which is interesting to see that they're moving from the full unsecured to the most secured of the spectrum.
Conservative treasurers.
Which is fine, because it's a new concept. It's a new it's a new way of working. They will have to take securities as collateral, so they need to be familiar with the concept of managing that collateral, although they can opt for third-party services, and then gradually we see them in cruising speed, they'll start to have that conversation with the bank and say, what can I do to improve the yield on my repo? And that's where the conversation will be, or maybe you should open up to lower grade collateral, introduce corporate bonds collateral, or equities, or emerging markets. And that discussion will drive actually the yield up according to the openness of the basket, which will allow the corporate treasurer to actually define the yield they want to target and align what they need in terms of collateral, in terms of tenor, and obviously in terms of counterparty.
Okay, excellent. Matt, what collateral do you include in your baskets?
So it is, I called it risk-free earlier, so treasuries, gilts, bunds and Dutch sovereigns. And that's it at this point. We've taken that approach because we're investing in private equity, we've got enough business risk and financial risk within our investments, so we want to minimise the amount of risk that we take within our top co. Now that said, as a theoretical point of view, I struggle to see where liquidity would be available in some of the collateral sets in the event of a counterparty default, because we're dealing with very well-rated, very large systemic banks. So actually, say if you looked at some corporate bonds, actually I wonder whether liquidity would be there and whether you could actually get a bid in selling it. Conversely, I actually think equities are quite interesting in that regard. You'd have to have a big haircut on the value of it, but actually I'd be pretty confident you could get liquidity in equities.
Which is indeed interesting that corporates are looking at, I would say, the equity collateral more than traditional repo counterparty, because indeed they are more familiar with that, and they're happy with the price discovery of the equity. So they know there's a market there because it's traded on the exchange. So they know they will be able to offload their equities, and obviously with the appropriate haircut. It's a good trade for corporate treasurer.
Excellent. Okay, moving on to GMRAs, Global Master Repurchase Agreements. One question that's come in, and Matt, this is probably for you. What cost, money and time did it take to negotiate each of your GMRAs? You may not want to mention exact amounts, but
Or which counterparty?
Yes.
Or which banks, you're right. But roughly, I mean, ballpark, what are the legal costs?
Yeah, so our legal costs were, say, let's call it in the region of 20.
Per GMRA?
No, overall.
Overall, okay.
Because we tried to negotiate, say, I think it was about 3 or 4 in one go. And actually we used that as a learning experience for all the GMRAs that we then wanted to do. And also, as I say, there's a really useful guide that was published by the law firm that we used, which actually just gave really good background about what you were dealing with and how each clause would operate and what was important about it. So actually from then we developed our own standard GMRA terms that we wanted to accept, and then started sending those out to the banks that we wanted to deal with beyond that original group of 3 or 4.
Okay. And what are the terms that you found contentious when you were negotiating your GMRA? GMRAs, plural.
So there were a number of, I mean, probably 50–60% wanted a cross default, which we refused. Probably a similar sort of proportion, but not the same banks, wanted set-off of transactions governed by the GMRA against other, say, credit agreements, which again we didn't want to include. We've managed to agree a position where there are no cross-default clauses in our GMRAs. There was one particular bank who did maintain that they had to have the set-off clause within the GMRA, and actually we both walked away on the basis that I've seen it before within ISDAs. I think it's really important that you've got a consistent set of documentation on the material, substantial terms, so we actually decided to hold the line.
Okay, excellent. And Olivia, you mentioned repo access as an agency agreement. What challenges have you found in trying to set up a standard GMRA?
Well, I think indeed the initiative was to leverage our own experience as a reverse repo investor, because the Euroclear Bank Treasury is active for more than 15 years with more than 30 counterparties in the reverse repo market. So what we try to do is actually to take all our GMRAs and take and derive a standard GMRA from that. I would say the most challenging part was to go to the banks and discuss with them. So, okay, this is the GMRA that we want to propose to the corporate treasurer, to avoid having them to go through this process of learning what a GMRA is all about. So that took us quite a while to come up to an agreed standard.
Okay, Matt, moving back to you, you mentioned 9 counterparties. Are there any differences in these GMRAs? Are they, to the letter the same, or?
No, as I say, I'd say the terms that are slightly different in each GMRA are actually the terms that get overridden by the tri-party arrangement. The ones that you really care about are the same. Okay,
and how big a challenge was it to align each of those, given you've got 9?
Some of them were very easy. It was some banks would ask for it, but it wouldn't be a serious negotiation. Some banks did have to go through a reasonably comprehensive approval process internally, but actually everybody got there apart from one. I mean, we were talking about it earlier. 9 banks is quite a large number. I've got quite a large bank group given the activities that we actually do. So we've probably got a couple of counterparties that we may add to it, but that's probably it.
Okay. Moving on, actually talking on number of counterparties, you mentioned 9, that is quite a lot. Do you plan to increase or decrease the number of counterparty banks in the near future?
Maybe 1 or 2, but that's it.
And why? Is that going up or down?
That's going up. I think I quite like having liquidity in this market, because actually it's complementary to money market funds, but actually in a period of true market stress, this is my bolt hole. So actually I'd quite like to have as much liquidity as I can get. And actually, given that it doesn't cost us anything legally, it takes a little bit of my time to negotiate, but it's not a particularly complex negotiation now.
Okay. Olivia, what is the typical number of corporates that you see corporate treasurers trading with? Or dealing with?
We see them coming to tri-party with their core banks. It's often a move away from the unsecured deposit to the repo with the same counterparty, but on a secured base, because these banks are less and less willing to take these deposits for regulatory capital constraints. So they're moving with their core banks, and once they feel comfortable with them, they will expand to, I would say, a range of 5 to 10 banks, because indeed they want to keep the liquidity, so they want to have a stable business with each of the banks, so they don't want to disperse that with too many banks, but they want to have access to the liquidity as well. So that the right balance seems to be between 5 and 10, I would say.
Okay. And tri-party agents, Matt, you mentioned you've got 2 tri-party agents. Why? Why have 2? And what difficulties or advantages and disadvantages are there to having 2?
I think the main disadvantage is the setup, but actually beyond that, when it's live and up and running, we have exactly the same process for both Euroclear and Clearstream. So from that point of view, it's been fine. Somebody did suggest to me that we do tri-party repo through BONI for US Treasuries, which I've decided to draw the line at.
Okay. Excellent. There's a question here, and I don't fully understand it, but I'm hoping you gentlemen will. It says, would similar processes be available in the GCC zone now or planned? Do you understand that? No.
The GCC zone, I suspect GCC countries, some Middle East, I would suspect.
I'm not quite sure. I just thought I thought it was an acronym I may not be aware of, but let's move on. Dealing platforms. So corporates generally deal repos on 360T, Bloomberg, or on the Collateral Management Agent's website or one of their systems. Matt, you mentioned Bloomberg Chat as the way that you deal in repos. Is it the same for all your bank counterparties, or do you use the phone as well?
The telephone is really for general market insight and discussion about future collateral sets. All of our execution is done over chat. We're working on getting good pricing visibility. It's not there from all banks at this point, but as I say, everything execution and confirmation-wise is Bloomberg. And as I said earlier, we wanted to choose a system that we already had that would be pretty simple to actually implement.
Okay, and Olivia, just on trading, I think you touched on there being a trading exchange. Could you expand on that? Is there a trading exchange for corporates to deal in repos?
I think that there are initiatives coming up to facilitate the trading on platforms.
So they're not there yet.
There are some are there, like the New Age or SocGen now agency cash management, which is an auction platform. So corporate treasury can select the number of banks they want to have in the auction room, and they will give their offer into the room, and the banks will bid, and then the result will end up into a transaction selected by the corporate. So this is happening already, and I think it's important for the bank for the corporate to make sure that they trade at the right level. And sometimes it's a bit difficult to find out what is the return on the 3-month repo with that kind of basket. And not only because the basket may be very different from one to the other, but also because then you have to ask each bank their prices. So that's why trading venues are coming up, and I think now they include corporate treasury, which wasn't the case in the past. So ACM is one of them. DBVX is coming towards the end of this year. So there are platforms that are actually getting the corporate treasury connected to the repo world.
Okay, excellent. We'll look forward to that.
And also another interesting aspect, I would say, is the baskets. How do you differentiate one basket versus another, and how can you figure out how much yield you can get if you move from one basket to the other? And that's why we're coming up now with the concept of standardized baskets. So we're proposing a range of baskets, 4 or 5 baskets covering the widest range of collateral that we see in our platform, and allow banks to put their price on the different baskets, so they can share that with the market. So that's an initiative we're working on right now. So more to come on that one.
Like a benchmark in some ways by basket.
And that could give an idea of where the basket could be traded, although obviously the specificities of the basket will be taken into consideration for the final trading price. Okay,
excellent. This question on collateral management. When banks swap collateral, what risk is there for the corporate? So I guess the question is if I interpret it, is when collateral is allocated to a corporate, is it sitting in a ring-fenced account? And what happens when the bank swaps that collateral? Because that's often written into repo contracts.
Yeah, absolutely. So the collateral received by a corporate is fully segregated from the bank. So that's a rule number one, risk management rule number one, specifically with tri-party agent. The assets are selected from the bank and moved to an account in the name of the corporate, fully segregated from the bank, because the corporate will need to have immediate and unrestricted access to the assets in the event of default as counterparty. There shouldn't be any authorization or any hurdle to liquidate the collateral, because time is important. If the bank is in a default situation, the likelihood of having a difficult market is high, hence they need to liquidate the collateral ASAP to recover the capital. So segregation and immediate and unrestricted access is a prerequisite, otherwise you cannot offer a reliable tri-party repo services. Talking about the collateral substitution, so there is in the GMRA the right of substitution, which means that the bank can at any point in time swap one piece of collateral versus another, obviously as long as the collateral they want to replace is in line with the requirement of the baskets. And in order to avoid any credit exposure, even intraday, what we do is, in order to organize the substitution, we inject two settlement instruction against payment in opposite direction, so that at any point in time, both the corporate and the banks are protected against any credit exposure against.
So they're both settling simultaneously. So
they're both settling simultaneously. So two transactions in opposite direction against the same cash amount to avoid any treasury position changes, and to make sure that at any point in time there is no credit risk, even on an intraday basis.
Okay, excellent. Question that's come in, and Stephen, maybe this is Matt, this is for you. Please outline the accounting used for 3I for repos and which standard that you report to. Is that your area, or is that more finance?
I can answer that. Because we are short dated on repo, we are accounting for them as deposits, and we are under IFRS.
Okay, excellent. Investment strategy. Matt, when you set up your repos, did you need to change your investment policy document at all, or was it all encompassing that repos could just slot straight in? And if not, what did you have to change, and how did you go about it?
So doing a repo wasn't specifically covered by the investment policy in terms of instruments that we could use. There were lots of other instruments that we could, but repo hadn't been included in it. Understandably so, given the history. We went through a process of education with my CFO, my general counsel, to make sure that everybody was comfortable with it on the executive side, and then took a refreshed paper around treasury policy to the board to actually specifically get approval for doing repo and particular collateral sets. So we've, within our treasury policy, agreed what collateral types we can actually have. But then myself and my CFO, as part of Treasury Transactions Committee, will actually get together and agree what those collateral sets really are in practice.
Excellent. Okay. This is an interesting question. Olivia, why don't I give this one to you? What impact in basis points does the repo process cost?
The question is, it depends who the writer.
How long is a piece of string?
Well, it's basically the pricing of the repo, and here I'm talking about the services linked to the processing of a repo is an asymmetrical thing, in the sense that it is market practice until it changes. It is the one looking to finance securities position that is picking up the tri-party bill. So from a corporate treasurer, we don't send invoices to corporate treasurer, so that's happy days from their perspective, as the invoice is taken up by the banks. Just to give you an order of magnitude, we're talking about a basis point or less if the bank is doing more big sizable business, as we apply what we call a sliding scale, with the top end is 1 basis point, and it goes down to a quarter of a basis point if the volumes are above a certain threshold. So
there's no fee. So from a procedures perspective, it's just like investing in money market funds, or
It is, and I think it is important for the repo market to make sure that there is no like additional cost to come into the repo for new liquidity providers, which are important for the banks, because they are from a Basel III perspective, they have a different risk-weighted assets weighting under the NSFR rules, which means that the banks are really looking to diversify away from financial counterparty to the corporate sector. So if we making it free is an incentive, an additional incentive to come into the repo market, and hopefully this will continue.
Excellent. Matt, you raised an interesting point in your presentation on that there being quite a focus on collateral instead of the primary risk, which is the counterparty risk. So my question really is any collateral better than no collateral?
Yes. Yeah. No, I think
expand, please.
It's. I mean, if I look back at what 3i was doing, say 3 years ago, then, or perhaps even 4 years ago, then we'd have money market funds and unsecured exposure, and that would be a roughly 50-50 split. We had a restructure, a reduction in treasury resource, so actually we're then focusing on money market funds. Now we've actually gone back the other way again, so that we're actually now able to move away slightly from money market funds and have more cash in repo. But actually, the thing that I really liked about repo was that actually you can have a relatively small number of counterparties, a bigger ticket size than you might ordinarily have on an unsecured basis, and actually get to a position where you had comparable or even in some cases better yield with still a better risk profile.
And what's your thoughts, Olivier?
I think it's a very good point. We have seen corporate treasury investing in their deposit with a larger number of banks for risk diversification purposes, which is actually creating other problems, which are more operational problems. As you see, Matt's team is a short, there's a small amount of people, and that's, I would say, what we experience with other treasuries, a small team. So if you spread across a large, variety of counterparty, you create operational risk. So the repo is a good way of, focusing on a couple of core banks and doing, bigger size, going to the repo market. And to your question, is collateral better than no collateral?
Yeah,
I think the answer is yes. Obviously, it will depend on the recovery rates that you can achieve by putting the right haircuts to make sure that you can be within the volatility when you need to liquidate the collateral, selecting the right collateral. But we really see a cap and a floor really in the repo market. So the floor would be repo with the best collateral. So what the market would call GC, so general collateral, say G7 government bonds, so that's a lower bound, and then you have the unsecured above. Yeah. And if anything in between is depending on the collateral you take. So you can get closer to the upper limit if you're happy with the credit risk on the bank, the primary risk, as Matt rightly said, by adjusting the collateral dimension to that. So it's really putting the yield where you want it to be in line with the credit appetite you have.
And the other thing to add, I think, is that we've not taken the approach that if we've got the best quality collateral, we're then happy to move down the yield curve in terms of the primary counterparty. So it's the primary counterparty risk that we always assess first, and the collateral is then a bonus above that.
Yeah, I think that's a very, very valid point. The counterparty first, adjust by the collateral as opposed to the other way around. Yeah. And I think some that were doing the other way around have learned it the hard way during the crisis.
Matt, a question for you. Have you pushed back to the banks if they propose to base it on a specific GIMRA, i.e. 1998 against 2000?
So we've got, all of our GIMRAs are 2000 except one which is a 2011. Now we ended up striking out some of the 2011 clauses, again the main contentious one being the set-off. But no, we don't have any 98 GIMRAs.
Okay, excellent. Well, I think we've reached the end of our time. A recording of this webinar will be uploaded on the ACT website, along with the presentation and slides in 2 days' time, and we'll be sending you all a link to that. You'll find details of future events and webinars on our website. The next ACT webinar will be on working capital on the 30th of June, and on the same topic, the ACT have their inaugural Working Capital Conference on the 15th of September. Please take time to fill in the feedback survey after the webinar ends. We do look at each and every one of them, And finally, thank you to Olivier and Matt and to Euroclear, and thank you for listening. Goodbye.
Thank you.
Thanks.